Welcome back, everyone. I wanted to kind of create a shorter type of video today where I wanted to go over my blog post from early this morning. I'm recording over lunch right now. I wanted to just kind of touch on some quick concepts that the blog goes into in a little bit more detail. Try to keep some of the high level items uh, brief here, if you will. So this morning I wrote a blog that was entitled "The Pin That Pops the Bubble and Why Gold and Silver Are the Money for the 21st Century." I'm going to do this in two parts here. First, I'm going to talk a little bit about the pin, which is the interest rates and why. In part two, I'm going to talk a little bit about this slide here that I created that's going to get me some hate mail. Uh, but the bottom line up front is for anybody that wants to just stop right now is that I think, and many others think, that interest rates that are going to be increasing are what's going to take the whole system down. So, with that, let's go through a couple of the points here. The first thing was I wanted to point out that when I was looking at the 10 year over the last 40 years, months ago, I saw it looked like this, and that is the psychology of a market cycle. Now, many of us have been talking about this with Bitcoin stuff, with gold, with silver, and how these things go on market cycles. So, if you look at this, the 10 year, I just want to kind of look at what the 10 year actually kind of represents is the risk off, and gold also is as well and is the competitor to the 10 year. But if the 10 year is risk off, this is an inverse, if you will, to the Dow over the last 40 years, in a sense. Now, the Dow, in the last 40 years, in nominal terms, in the cost of the Dow and the Dow index has changed its composition. But the point is that this is an inverse of what you would consider the bull market over the last 40 years. And what I would suggest here is that this is pretty much at the end of that cycle, and it looks like it's going to be rising up again. And what that means is if this is rising up, the markets would be kind of going down. So, yeah, with that, what is going to be the cause of these rates going higher? And typically, if you look at the 1970s, when the rates were rising a lot, it was because of inflation. When inflation gets too hot, the interest rates start to rise, trailing it to kind of ensure that the markets don't get too hot. The problem with it being is that we are stuck in a form of a bear trap right now. Not like a bear trap technical trading, but legitimately look to see if the bear is in a trap. He can't really go anywhere. So um, the Fed is basically stuck where you can't have the rates going pretty much up over 2%, or you worry about stock market collapsing. But with that, Lynn Alden had created a blog post, talked about three different types of inflation. Take a look at it. I'll make a comment in the show notes here. Um, Also, I was listening to Frank Giustra on Palisades. He had also talked about some of this as well, so it's good timing with him. Side note is I think Frank Giustra is now added to my list of people like John Lee that I wanted to kind of shut down a bar with at 2 o'clock. But now I'm rebranding this, and I'd like to suggest that this is maybe people I would like to have over at a dinner party because I don't drink anymore. I haven't drank really in like 10, 15 years. But I would suggest that a lot of the people I'm going to be talking about for that list, when I'm going to be creating a blog post on that as well, I would imagine none of them are shutting down a bar at 2 o'clock in the morning either. So, who would I like to have a dinner party with? I'm going to be creating my Mount Rushmore down the road. If you have anybody that you would like to have dinner party with, who is on your Mount Rushmore, if you will, why don't you put some of the names below here, because I'd like to see who you guys like. Maybe there's somebody that's not on the radar that you guys like that I can take a look at. But something Frank brought up this morning that he's a big fan of physics and astrophysics, and I'm going to get into some stuff in part two here that goes into a little bit of that. I'm not going to give it away right now, but anyway, with Lynn and the article, she was talking about inflation, and what I wanted to touch on with that is that um, inflation has been showing that it's been low over the last 40 years, and this has allowed the 10-year to go down. But what if the concept of what we think of as inflation as the 2% is not real? I know that Mike Maloney calls it the CPI lie. I know that, and part of Lynn's article, why I wanted to bring this up, was she had made mention that there's two camps out there. One that thinks that the CPI is severely understated, and then you have another camp that's like they're still looking for inflation, that they think the CPI is overstated. So with that, I linked in my blog post the Chapwood Index, and I had also listed the what is it here? The shadowstats.com. Now, shadowstats.com has suggested if we use the 1980 numbers that we're hovering somewhere around 10%. If you look at the Chapwood Index, that would basically suggest that in all of these big cities, now I'm closer to Philadelphia here, and it would suggest that over the last 5 years, the average is 10% each year of inflation. So why is that not in the CPI? So what the CPI covers is pretty much not a lot of what people are like. I call it dinner table inflation. So the CPI might not be covering the cost of corn, might not be covering your medical bills, it might not be covering your rents that are going up, but that's the inflation that everybody's seeing, and that's what people panic about, and that's what people are worried about. So with that, if you're thinking about it, and inflation is actually 10% and it's not 2%, if this starts to become well known to people that the CPI is not 2%, it's not 3%, and if it's known to us and it's known to foreign countries that invest in our country, what kind of pressure is that going to be putting on our 10 years or our bonds? Because people are going to start selling, because if these bonds are severely like think about this, like, would you really want to take money and put it into a bond and get 2% back if you're losing every year 8% or 10% of your spending power? So that's the problem that people are going to be faced with nowadays, is that when people start to realize that inflation is a lot higher than what people think it is, that's going to cause a lot of the pressure on the 10-year, which is going to start to drive the rates up. And we're already starting to see some rollover in some of the stock markets, a little bit in the tech side of things. So how I think this is going to play out, I'm just going to read a couple of these things. Basically, the CPI should be going up over the course of a period of time. More and more people are going to be reading stories. The bots and the algos may actually be doing selling and buying without us even participating in this. The Fed is already buying 120 or so billion in bonds per month. So they're already doing something that people call yield curve management. And we've all heard people on YouTube saying if rates are 2%, it may destroy the stock market. Well, it's also quite possible that they do more of this yield curve management, yield curve control, and the rates get at 1.8 to 2%. And in a sense, they are going to be stuck in kind of like a middle, a channel going up and down, bouncing around for months or years. But the problem with it being is, what about the consumers out there? And everybody starts to understand that inflation is 10%. So I think that there's going to be a lot of panic selling at some point in time, and the people that probably know about this will be selling first, and then there's going to be a lot of people left holding the bag on this. I fear with this that the Fed starts losing control of the 2% then, and when they start to lose control of the 2%, is that just going to be now more and more pressure on the 10-year? And is this going to be a situation where, from what I read, the Fed actually has about 23% of our debt, whereas you have Japan and Italy and maybe some others that are 40 or 50% or whatever it is. So right now the Fed balance sheet is at $7 trillion. I mean, could the balance sheet start to explode to absorb more of our own debt, 10, 12, 20 trillion? At what point in time does the Fed absorbing all of this debt then start to take into question, our dollar? And with that means there's going to be more and more printing. What's also not mentioned here is I'm a little bit worried about You know, some of the mortgage defaults. I'm worried about. Um, you know, Problems with banks, with all kinds of mortgage defaults and businesses failing from COVID issues. I see a lot of issues with all of this that is going to be continuing all this money printing. More on that later when I'm talking about Bitcoin. So I'm also seeing that people are going to start to realize that the Fed is the only buyer. They're not going to be the buyer of last resort. They're going to be the buyer of only resort. And now, at some point in time, I think the stock market could have that 10-20% pin pop. It might be 5%, but will the Fed be backstopping a whole bunch of this? I don't know. Uh, so part of this also is what about Frank Giustra was also talking about that he feels that there is 50 cents for every dollar that's invested right now that's just sitting on the sidelines. And he's not so sure that if there's a crash that it's going to come running back in. But also you're looking at people that are holding U.S. dollars in foreign reserves. Now, if all of a sudden inflation is known as 10%, I want you to ask yourself this. All these people with the 50 cent for a dollar that is sitting on the sidelines, all these foreign countries that are sitting on dollars, and if it's well known that inflation is 10%, they're going to want to get out of dollars. And that's one of the problems I would suggest that there might be with the dollar milkshake theory is that if there's a market crash, most people think that, if this starts to go down, 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 many people think that, oh, wait a second, they're going to rush to the dollar. Well, if inflation is indeed 10% and the bonds are 2%, they may short term go into the dollar so then they can turn around and put it into precious metals. There's a whole lot of money that would be on the sidelines that could then go into the precious metals or crypto, and I'll get into that a little bit later as well. But Mike Maloney also mentions that there's a whole bunch of gold that's going from the west to the east right now. And on top of that, right now we're seeing all kinds of commodities prices that are just going crazy. Now, yes, there are supply chain issues going on, but what if, and I say what if, there's a lot of this cash that's on the sidelines from perhaps foreign countries that's coming to our country and then taking our goods and the like away from there. I'm sure you can probably measure that, but if I'm a foreign country right now and I'm sitting on US dollars and it's being devalued by 8 to 10% per year, I'm going to want to put that into something more tangible, which is why you're looking at gold and the like. So one of the things that people want to talk about is the Bank of Japan. They've been going kind of sideways for a while. They have negative rates, if you will. But the Bank of Japan is not the world's reserve currency. And that's the problem that you're looking at right now, is that all these countries that have dollars, they're going to want to send it here, and then all of a sudden our inflation is going to go through the roof. So whereas, you think of a stock market collapse, if you will, or a severe correction, because of interest rates going up, but if you're thinking about well-known companies that have been around for 50 years that they can survive a 10% correction no problem. But if you're looking at like the SPACs and some of the crazy tech stocks and some of those that have those wild PE ratios, and even the 38% of the companies that are zombie companies that are out there, that's where you're going to be running into the issues where some of them are going to drop, and that it's going to take the indices down. And you're going to see a lot of rotation into gold and perhaps crypto. But part of what I would suggest here is if the DXY is going to be going down, if your crypto is valued in US dollars or fiat of any nature, and all the fiats are devaluing, will your crypto devalue? So one of the big criticisms I have of any form of crypto right now that is unbacked is that it's not seen any kind of recession. So if there is if there is a form of stock market correction that leads into a longer term recession, no one knows on the planet how cryptos are going to react, and that's a big risk. I did write a blog post about that. I thought that Bitcoin was kind of a risk on, if you will, type of thing, where it's almost like a nugget for the S&P, if you will. So there's pretty much the end of part one with that. I wanted to kind of go into a slideshow that I have here. I'm just going to kind of skip through some of this stuff. Let's see. Here we go. Okay, so where you have with, let's see, with, there we go. Okay, sorry about that, folks. So here is the main slide that I want to talk about a little bit. I'm going to go through this real quick, and I'm going to come back to this at the end. So one of the things you hear Saylor talk about a lot, and you also hear Steve Santangelo talk about. They talk about energy that's stored in whether it's Bitcoin or gold. And I have a big theory out there that I created something completely different called financial energy, and I've heard people like Mike Maloney talk about it. However, some of the issues you run into with talking about financial energy is it's not physical energy. So I have a 6-part series I wrote these big blog entries on, and I wanted to do a longer videos on that. But for right now, what the big thing here is that my concept is financial energy moves processes where physical energy moves things. So I'll get into that a little bit later. But how do you unlock financial energy, if you will? So let's just say that your financial energy, I'm calling it joules. Now this is a play on joules of electricity, which, Giustra might actually like some of this concept here. So you have joules of financial energy, and let's just say you have 100 of them with your business. You unlock your financial joules of energy, and you start a process where you want to take raw materials and you hire labor, and then you buy a factory or you rent space in a factory, and from there your output is a product. So basically your financial joules, you're trying to do an ROI. So pretty much when you're digging gold out of the ground, anything that you're putting into that process, you want to have more coming out of that process than you put into it. So it's the same thing in a sense with Bitcoin mining. However, I kind of call that a hamster wheel. It's I'm gonna get hate mail for that one too. but the concept here is that whenever you're mining something, you want to have more out of it than you're putting into it. So what you worry about with Bitcoin mining and even with gold mining is, what if the price of the underlying good starts to go down? Well, you stop mining. So I just wanted to talk about that a little bit with financial energy. Now, one of the other things is I talk about gold as the center of the financial solar system, which is it's gonna link up to that big slide I was talking about earlier. So yeah, gold has been money for 5,000 years, and in 1971 we went off the gold standard, as most of you know. But what I would consider then is that pretty much everything is valued in gold. That 5,000 year of history gives people a pretty good idea that, hey, look, I know that 100 chickens is worth 1 ounce of gold, or whatever it is, whatever 40 ounces of silver might be worth 1 ounce of gold. You have relative value. So what you can suggest right now is that if there was a currency collapse in the US dollars, whatever currency we ended up going into, the first thing that would have to happen is you would have to understand what its price in gold is. And you can say, hey, the next currency system is coming out, and I'm calling them joules. And one ounce of gold is equal to 1,000 joules. Well, what's going to happen is everything else is going to be priced off of that. And the geocentric model is what I'm considering is what happened in 1971 when we try and put fiat at the center of our fake solar system and not back it on anything. There's no history of fiat relative to goods and services. So this is the problem you're running into. This is why all of our markets have been failing over the last 50 years, and why all of them have non-elected bureaucrats essentially picking winners and losers. I don't want to get too much into that, but big picture here is that gold is the natural center of our financial system, and I'll get into that more. But what you would see is when you're spending and you're collecting financial energy, it's a sine wave of sorts, and you're going to see that below. Now this is kind of like something going around the sun, and look how it creates these nice waves. Basically it's the business cycle, if you will. So, for instance, if you want to go into gold priced in oil priced in gold, you know, oil is there, and all of a sudden, you know, it starts going up in price because it's getting more scarce. It starts to become more in gold. It costs more in gold, and more companies run to create oil. Oil supply drives the prices down. And then what happens is, you know, when there's more supply, the price in gold drops. Oil starts to become cheaper, and the supply is reduced. Less people are making it, but and companies leave the market. But those that are less efficient leave the market. Those that have the best processes stick around. So then it repeats all over again because oil is then cheap in gold. There's undersupply concerns, and that's kind of what's happening now in a sense. Demand goes through the roof, and that drives up the price of oil in gold. And this is kind of seen like this. This is over the last 40 years. You can see if you measure the price of oil in gold, this is kind of what it looks like. Now, this is what, if you go back to 1950, this is what the price of oil looks like in fiat. Okay? Now, that is not, look at all those booms and busts. This is, if you were pricing something, if you were pricing oil in gold, pretty much it averages, what was it, 1.9 something grams over the last 40 years. Now, again, this is the business cycle, but it's all price relative in gold. And you can see this in a bunch of other things, copper, silver. And now I'm talking about this specifically in commodities, but you can see that there's boom and bust cycles in a sense with real estate and with the Dow. Whereas there's opportunities that Mike Maloney talked about some of this with the the wealth cycles, about when you get into real estate, when you get out of gold, when you do these types of things. But the big picture here is if you're pricing things in gold, you're going to understand where I'm going with this in a second. So basically the goal here that a lot of the sound money people want to do is they want to fix your money. Like if you can go back to gold and silver, then this problem that you're talking about in this chart here, people want to have the minimum wage go up to $15. But if we were still paying people in silver, you know, from 1964, that was the minimum wage, was five quarters back in 1964. Now, if you go to 2021 and you're still paying people those 5 quarters, that is actually $24 per hour. And they're begging essentially for $15 an hour minimum wage. But if you just had paid people in silver the entire time, they would be making a very good wage. So, you know, the big thing here is we don't need to raise the minimum wage. We need to fix the money. But this goes back to what I was talking about to start this off, where, you know, basically the sound money people of gold and silver for what we've been advocating in a sense is a return to where you have that $20 bill and there's the gold label on it, if you will, where you know, and also I'm a big fan of Kinesis and other cryptos that are backed by gold and silver, and what that allows you to do is it allows you to take, well, you know, 1 ounce of gold and maybe divide it by 1,000,000 times. Now in the Giustra versus Saylor debate that they had, Saylor brought up a very good point. He said there's only 5 billion ounces of gold out there, but there's 8 billion people, so it doesn't make sense to have that as a physical money. And I agree. I absolutely agree. And that's where, you know, the crypto side of things can, you know, salami slice that thing up, you know, 100 million times, 1 billion times, whatever it is. And if you wanted to use paper, you could do the same thing, if you will, with that. So you could make it divisible with paper. On the Bitcoin side of things, now here's where Saylor differs from other people in the Bitcoin community. There's a big thing right now that Saylor is talking about, is he wants it to be a pure of gold, and he's talking Bitcoin about being a crypto asset and not a cryptocurrency. However, go to Wikipedia, look up cryptocurrency. The first thing that pops up is a Bitcoin thing. Now, Bitcoin.org also talks about it as a cryptocurrency and money. Okay, so Saylor appears to be wanting to brand this as a rival to gold, and he will actively come out and say sell your gold and get into Bitcoin. So there is a war here on what is your store of value. So, you know, the sound money guys from gold and silver are saying, hey, there's only so many ounces in the ground, and, you know, you can't print money. Okay? The Bitcoin people are saying, well, there's only so many Bitcoin. But the problem is you can print fiat. And here's the big thing of why I was talking about the financial of the solar the financial center of the solar system, because if your currency, the US dollar, collapses tomorrow and this gold and silver is there, whatever currency you decide to pick up tomorrow, it will be valued first in gold, and then gold will then reprice all commodities in that currency, and then all the finished goods on top of that will then get priced off of how much all of the material costs are. On the flip side, if the US dollar or your other favorite fiat currency collapses to zero, your Bitcoin is worthless. But here's the kicker here. Bitcoin has no relative value to any commodity. So if the US dollar collapsed tomorrow and we're just going to say, well, wait a second, we want to have, this new currency and it's going to be valued in Bitcoin. Bitcoin is going to be the store of value for this. Well, how much does it cost for copper in Bitcoin? I have no 5,000 year history on that. I just have, a nice big, huge run up of Bitcoin in US dollars. And likewise, all these other coins I'm sure Sailor would like them to be priced in Bitcoin. So that is the big takeaway here, is that gold and silver are the price maker and Bitcoin is a price taker. And I say that because of this. This whole big thing here right now is Austrian economics on one side on the left versus MMT on the right. Now, I think Sailor is a very, very bright gentleman because obviously he has MIT in his background, and I don't think he's too dumb to understand gold and silver. I think Michael Saylor realizes that there is a possible reality down the road of MMT. And with that, that means that they will print money to infinity. So in Michael Saylor's case, he's saying, hey, let's get on this train. Let's buy a Bitcoin for 10,000, 50,000. We're going to buy this Bitcoin. And we know that they're going to print this money to infinity. And we know that they're just going to keep doing it. They're going to keep buying tanks. They're going to keep doing whatever it is that they do with that money. And because of that, that's going to create massive amounts of inflation. And because of that, Bitcoin is going to absorb a lot of that inflation. So in a sense, Bitcoin is then going to be priced in US dollars, and it only goes up if the supply of money goes up. Whereas on the flip side, on the left side here, if you have a fixed supply of gold and silver that you're pulling out of the ground that is essentially grows at the rate of your population, and you can only divide those piles that are in vaults somewhere, okay? What that does is it limits the amount of money that you can print in currency. You see that $20 bill there that's backed by gold? You can only print so many of them if you have so many gold piles that are in your vaults. So what does that do? The Austrian side of things will constrict your government spending. It will constrict the military spending. It will constrict your social welfare spending. It will constrict the ability to do free college for everyone. It will constrict all kinds of spending. On the right-hand side, that is MMT. It basically says you print for whatever, but this asset class is now being devised because I know that if this is going to go up forever, I'm going to be able to absorb your inflation. Well, here's the thing. Gold and silver can absorb that inflation as well. So what's the point of needing Bitcoin? But the blockchain, well, if you're looking over at gold and silver types of things like Kinesis, it's using the blockchain as well. However, what you guys are all looking at is on the right-hand side, you're looking at, hey, I need to go to a crypto exchange to find a value in US dollars. That Kinesis, KAG or KAU, doesn't necessarily need to go to an exchange to find a value because its value is found in gold and silver. And that token is just a way of spending it. So if you have a lump of gold in front of you, that's great, but you can't spend it to buy anything online. So Anyway, I don't want this to be a huge Bitcoin versus gold war type of thing. But my point here is that if MMT is going to happen, I can see Saylor's point of throwing money into Bitcoin because it can rapidly absorb inflation, whereas gold and silver is problematic with pricing with the COMEX. So there is a possibility that if MMT is around for the next 20, 30, 40, 50 years, that Saylor could be very right about this. However, none of us know who's going to win this war. I can tell you this. Pretty much most central banks in the entire world have gold. That's pretty much a well-known fact right now. And I know Ben Bernanke used to say that we had gold because it was just, what was it, for tradition? But I can tell you, wars over the last 5,000 years have been fought over gold. And most central banks now hold gold not for tradition. If currencies collapse, everything's going to get repriced in what gold that the country has in their reserves. And I can tell you this, for the better part of 4,900 years we had 4,950 years we had gold-backed currencies, and now in the last 50 years we haven't. So look at what's been happening with all of the situations, with all of the things that have been going on in our civilization. That's another part of my 6-part series, but for now I just wanted to leave it off where if there is mass inflation that's going on, and if there is a run out of tech stocks, both of these asset classes are going to be absorbing. But the question for you is, if the DXY crashes, if it crashes, how is Bitcoin and how are these other coins going to react? And I'm going to leave it there. Leave your comments below, and thanks a lot.